what we're going to do is walk through step by step how you might have invented your own version of Bitcoin. We'll start with you keeping track of payments with your friends using a communal ledger, and then as you start to trust your friends and the world around you less and less, and if you're clever enough to bring in a few ideas from cryptography to help circumvent the need for trust, what you end up with is what's called a cryptocurrency. You see, Bitcoin is just the first implemented example of a cryptocurrency, and now there are thousands more on exchanges with traditional currencies. Walking the path of inventing your own can help to set the foundations for understanding some of the more recent players in the game, and recognizing when and why there's room for different design choices. In fact, one of the reasons I chose this topic is that in the last year, there's been a huge amount of attention and investment and, well, honestly, hype directed at these currencies. And I'm not going to comment or speculate on the current or future exchange rates, but I think we'd all agree that anyone looking to buy a cryptocurrency should really know what it is. And I don't just mean in terms of analogies with vague connections to gold mining. I mean an actual direct description of what the computers are doing when we send, receive, and create cryptocurrencies. One thing worth stressing, by the way, is that even though you and I are going to dig into the details here, and that takes meaningful time, you don't actually need to know those details if you just want to use the cryptocurrency. Just like you don't need to know the details of what happens under the hood when you swipe a credit card. Like any digital payment, there's lots of user-friendly applications that let you just send and receive the currencies without thinking about what's going on. The difference is that the backbone underlying this is not a bank that verifies transactions. Instead, it's a clever system of decentralized trustless verification based on some of the math born in cryptography. But to start, I want you to actually set aside the thought of cryptocurrencies and all that just for a few minutes. We're going to begin the story with something more down to earth: ledgers and digital signatures. If you and your friends exchange money pretty frequently, paying your share of the dinner bill and such, it can be inconvenient to exchange cash all the time. So you might keep a communal ledger that records all of the payments that you intend to make some point in the future. Alice pays Bob $20, Bob pays Charlie $40, things like that. This ledger is going to be something public and accessible to everyone, like a website where anyone can go and just add new lines. And let's say that at the end of every month, you all get together, look at the list of transactions, and settle up. If you spent more than you received, you put that money in the pot, and if you received more than you spent, you take that money out. So the protocol for being part of this very simple system might look like this. Anyone can add lines to the ledger, and at the end of every month, you all get together and settle up. Now, one problem with a public ledger like this is that anyone can add a line. So what's to prevent Bob from going and writing Alice pays Bob $100 without Alice approving? How are we supposed to trust that all of these transactions are what the sender meant them to be? Well, this is where the first bit of cryptography comes in: digital signatures. Like handwritten signatures, the idea here is that Alice should be able to add something next to that transaction that proves that she has seen it and that she's approved of it. And it should be infeasible for anyone else to forge that signature. At first, it might seem like a digital signature shouldn't even be possible. I mean, whatever data makes up that signature can just be read and copied by a computer, so how do you prevent forgeries? Well, the way this works is that everyone generates what's called a public key-private key pair, each of which looks like some string of bits. The private key is sometimes also called a secret key, so that we can abbreviate it as SK while abbreviating the public key as PK. Now, as the name suggests, this secret key, it's something you want to keep to yourself. In the real world, your handwritten signature looks the same no matter what document you're signing. But a digital signature is actually much stronger, because it changes for different messages. It looks like some string of ones and zeros, commonly something like 256 bits, and altering the message even slightly completely changes what the signature on that message should look like. Speaking a little more formally, producing a signature involves a function that depends both on the message itself and on your private key. The private key ensures that only you can produce that signature, and the fact that it depends on the message means that no one can just copy one of your signatures and then forge it on another message. Hand in hand with this is a second function used to verify that a signature is valid. And this is where the public key comes into play. All it does is output true or false to indicate if this was a signature produced by the private key associated with the public key that you're using for verification. I won't go into the details of how exactly both these functions work, but the idea is that it should be completely infeasible to find a valid signature if you don't know the secret key. Specifically, there's no strategy better than just guessing and checking random signatures, which you can check using the public key that everyone knows. Now think about how many signatures there are with a length of 256 bits. That's 2 to the power of 256. This is a stupidly large number. To call it astronomically large would be giving way too much credit to astronomy. In fact, I made a supplemental video devoted just to illustrating what a huge number this is. Right here, let's just say that when you verified that a signature against a given message is valid, you can feel extremely confident that the only way someone could have produced it is if they knew the secret key associated with the public key you used for verification. Now, making sure that people sign transactions on the ledger is pretty good, but there's one slight loophole. If Alice signs a transaction like Alice pays Bob $100, even though Bob can't forge Alice's signature on a new message, he could just copy that same line as many times as he wants. I mean, that message-signature combination remains valid. To get around this, what we do is make it so that when you sign a transaction, the message has to also include some sort of unique ID associated with that transaction. That way, if Alice pays Bob $100 multiple times, each one of those lines on the ledger requires a completely new signature. Alright, great. Digital signatures remove a huge aspect of trust in this initial protocol. But even still, if you were to really do this, you would be relying on an honor system of sorts. Namely, you're trusting that everyone will actually follow through and settle up in cash at the end of each month. What if, for example, Charlie racks up thousands of dollars in debt and just refuses to show up? The only real reason to revert back to cash to settle up is if some people, I'm looking at you, Charlie, owe a lot of money. So maybe you have the clever idea that you never actually have to settle up in cash as long as you have some way to prevent people from spending too much more than they take in. Maybe what you do is start by having everyone pay $100 into the pot, and then have the first few lines of the ledger read, Alice gets $100, Bob gets $100, Charlie gets $100, etc. Now, just don't accept any transactions where someone is spending more than they already have on that ledger. For example, if the first two transactions are Charlie pays Alice $50 and Charlie pays Bob $50, if he were to try to add Charlie pays you $20, that would be invalid as if he had never signed it. Notice, this means that verifying a transaction requires knowing the full history of transactions up to that point. And this is, more or less, also going to be true in cryptocurrencies, though there is a little room for optimization. What's interesting here is that this step removes the connection between the ledger and actual physical US dollars. In theory, if everyone in the world was using this ledger, you could live your whole life just sending and receiving money on this ledger without ever having to convert to real US dollars. In fact, to emphasize this point, let's start referring to the quantities on the ledger as ledger dollars, or LD for short. You are, of course, free to exchange ledger dollars for real US dollars. For example, maybe Alice gives Bob a $10 bill in the real world in exchange for him adding and signing the transaction Bob pays Alice 10 ledger dollars to this communal ledger. But exchanges like that, they're not going to be guaranteed by the protocol. It's now more analogous to how you might exchange dollars for euros or any other currency on the open market. It's just its own independent thing. This is the first important thing to understand about Bitcoin, or any other cryptocurrency. What it is a ledger. The history of transactions is the currency. Of course, with Bitcoin, money doesn't enter the ledger with people buying in using cash. I'll get to how new money enters the ledger in just a few minutes. But before that, there's actually an even more significant difference between our current system of ledger dollars and how cryptocurrencies work. So far, I've said that this ledger is in some public place, like a website where anyone can add new lines. But that would require trusting a central location, namely, who hosts the website, who controls the rules of adding new lines. To remove that bit of trust, we'll have everybody keep their own copy of the ledger. Then when you want to make a transaction, like Alice pays Bob 100 ledger dollars, what you do is broadcast that out into the world for people to hear and to record on their own private ledgers. But unless you do something more, this system is absurdly bad. How could you get everyone to agree on what the right ledger is? When Bob receives a transaction, like Alice pays Bob 10 ledger dollars, how can he be sure that everyone else received and believes that same transaction? That he'll be able to later on go to Charlie and use those same 10 ledger dollars to make a transaction? Really, imagine yourself just listening to transactions being broadcast. How can you be sure that everyone else is recording the same transactions and in the same order? This is really the heart of the issue. This is an interesting puzzle. Can you come up with a protocol for how to accept or reject transactions, and in what order, so that you can feel confident that anyone else in the world who's following that same protocol has a personal ledger that looks the same as yours? This is the problem addressed in the original Bitcoin paper. At a high level, the solution that Bitcoin offers is to trust whichever ledger has the most computational work put into it. I'll take a moment to explain exactly what that means. It involves this thing called a cryptographic hash function. The general idea that we'll build to is that if you use computational work as a basis for what to trust, you can make it so that fraudulent transactions and conflicting ledgers would require an infeasible amount of computation to bring about. Again, I'll remind you that this is getting well into the weeds beyond what anyone would need to know just to use a currency like this. But it's a really cool idea, and if you understand it, you understand the heart of Bitcoin and of other cryptocurrencies. So first things first, what's a hash function? The inputs for one of these functions can be any kind of message or file, it really doesn't matter. And the output is a string of bits with some kind of fixed length, like 256 bits. This output is called the hash or the digest of the message, and the intent is that it looks random. It's not random, it always gives the same output for a given input. But the idea is that if you slightly change the input, maybe editing just one of the characters, the resulting hash changes completely. In fact, for the hash function that I'm showing here, called SHA-256, the way the output changes as you slightly change that input is entirely unpredictable. You see, this is not just any hash function. It's a cryptographic hash function. That means it's infeasible to compute in the reverse direction. If I show you some string of ones and zeros and ask you to find an input so that the SHA-256 hash of that input gives this exact string of bits, you will have no better method than to just guess and check. And again, if you want to feel for how much computation would be needed to go through 2 to the 256 guesses, just take a look at the supplement video. I actually had way too much fun writing that thing. You might think that if you just really dig into the details of how exactly this function works, you could reverse engineer the appropriate input without having to guess and check. But no one has ever figured out a way to do that. Interestingly, there's no cold, hard, rigorous proof that it's hard to compute in the reverse direction. And yet, a huge amount of modern security depends on cryptographic hash functions and the idea that they have this property. If you were to look at what algorithms underlie the secure connection that your browser is making with YouTube right now, or that it makes with your bank, you will likely see the name SHA-256 show up in there. For right now, our focus will just be on how such a function can prove that a particular list of transactions is associated with a large amount of computational effort. Imagine someone shows you a list of transactions, and they say, hey, I found a special number so that when you put that number at the end of this list of transactions and apply SHA-256 to the entire thing, the first 30 bits of that output are all zeros. How hard do you think it was for them to find that number? Well, for a random message, the probability that a hash happens to start with 30 successive zeros is 1 in 2 to the 30, which is about 1 in a billion. And because SHA-256 is a cryptographic hash function, the only way to find a special number like that is just guessing and checking. So this person almost certainly had to go through about 1 billion different numbers before finding this special one. And once you know that number, it's really quick to verify. You just run the hash and see that there are 30 zeros. So in other words, you can verify that they went through a large amount of work, but without having to go through that same effort yourself. This is called a proof of work. And importantly, all of this work is intrinsically tied to the list of transactions. If you change one of those transactions, even slightly, it would completely change the hash. So you'd have to go through another billion guesses to find a new proof of work, a new number that makes it so that the hash of the altered list together with this new number starts with 30 zeros. So now think back to our distributed ledger situation. Everyone is there broadcasting transactions, and we want a way for them to agree on what the correct ledger is. As I said, the core idea behind the original Bitcoin paper is to have everyone trust whichever ledger has the most work put into it. The way this works is to first organize a given ledger into blocks, where each block consists of a list of transactions together with a proof of work. That is, a special number so that the hash of the whole block starts with a bunch of zeros. For the moment, let's say that it has to start with, 60 zeros, but later we'll return back to a more systematic way you might want to choose that number. In the same way that a transaction is only considered valid when it's signed by the sender, a block is only considered valid if it has a proof of work. And also, to make sure that there's a standard order to these blocks, we'll make it so that a block has to contain the hash of the previous block at its header. That way, if you were to go back and change any one of the blocks, or to swap the order of two blocks, it would change the block that comes after it, which changes that block's hash, which changes the one that comes after it, and so on. That would require redoing all of the work, finding a new special number for each of these blocks that makes their hashes start with 60 zeros. Because blocks are chained together like this, instead of calling it a ledger, it's common to call it a blockchain. As part of our updated protocol, we'll now allow anyone in the world to be a block creator. What that means is that they're going to listen for transactions being broadcast, collect them into some block, and then do a whole bunch of work to find a special number that makes the hash of that block start with 60 zeros. Then once they find it, they broadcast out the block that they found. To reward a block creator for all this work, when she puts together a block, we'll allow her to include a very special transaction at the top of it, in which she gets, say, 10 ledger dollars out of thin air. This is called the block reward, and it's an exception to our usual rules about whether or not to accept transactions. It doesn't come from anyone, so it doesn't have to be signed, and it also means that the total number of ledger dollars in our economy increases with each new block. Creating blocks is often called mining, since it requires doing a lot of work, and it introduces new bits of currency into the economy. But when you hear or read about miners, keep in mind that what they're really doing is listening for transactions, creating blocks, broadcasting those blocks, and getting rewarded with new money for doing so. From the miner's perspective, each block is kind of like a miniature lottery, where everyone is guessing numbers as fast as they can until one lucky individual finds a special number that makes the hash of the block start with many zeros, and they get the reward. For anyone else who just wants to use this system to make payments, instead of listening for transactions, they all start listening just for blocks being broadcast by miners and updating their own personal copies of the blockchain. Now, the key addition to our protocol is that if you hear two distinct blockchains with conflicting transaction histories, you defer to the longest one, the one with the most work put into it. If there's a tie, just wait until you hear an additional block that makes one of them longer. So even though there's no central authority and everyone
Welcome everybody to the cryptocurrency live stream, and welcome to Daily Crypto Technical Analysis. On today's live stream, we are going to do daily Bitcoin and also Ethereum price prediction for intraday trading using different indicators and also price action. For Bitcoin right now, it actually does look like. Today, we actually got a beautiful pull to the upside, exactly to our price target. We got also right now actually a very nice rejection to the downside with a bearish retest of our bottom of the range. And as of right now, it also does look like we are actually seeing some more movement to the downside here on the Bitcoin price. On today's live stream, we are going to talk about our next support level for Bitcoin if we are actually going to continue our way to the downside. I am going to be showing to you a potential pattern that is right now actually developing here on the Bitcoin chart. I am going to give you the price targets, and also I am going to give you the reason why personally I'm actually not trading this specific pattern unfolding right now on the Bitcoin chart. We are going to also talk where potentially you could maybe even be interested going with another long, maybe even with another short position here on the Bitcoin price. And after we are done with Bitcoin, we are actually going to go straight to Ethereum. Ethereum also right now, it actually does look like we are once again below our support level of the range. And on the Ethereum chart right here, we are also going to be mentioning our next support level if we are going to see lower price targets. We are also going to look at the Ethereum Bitcoin chart because actually someone today in the Discord server actually mentioned that we have a beautiful and very nicely respected Fibonacci speed fan diagonal resistances. I'm actually also going to be showing to you that. And also, after we are done with Ethereum and Bitcoin, we can also, of course, look at some of the altcoins that you are going to suggest in the chat. But as of right now, I mean, if we just really quickly actually once again look at the Solana chart, definitely does look like we are seeing a pull to the downside from its all-time high from $75. Luna still staying very, very strong with another all-time high at around $27 right here. So with it being said, make sure you are actually relaxed and you watch the entire live stream because it is going to be for sure a very interesting one. With it being said, let me welcome everyone on the stream, and then we are actually going to go straight into Bitcoin price prediction, Ethereum price prediction, and also maybe other cryptocurrencies such as I actually said, Cardano, maybe before Solana, Luna, etc, etc. Yo, I mentioned the speed fan in the Discord. Cheers to, or shout out to Rodri Ken. Thank you very much for actually saying the respected Fibonacci speed fan. Thank you very much for mentioning that. Darwin Castro, thank you very much for €5 donation. Welcome man to the stream. It does look like this is some kind of a Japanese dog right here. Very, very interesting. Welcome to the stream. JRN PTRS, of course, also man, welcome to the stream. Andrea, still thinking bull trap and it will go down after Bitcoin hits $51,000. To be honest right now, where Bitcoin is at the moment, in my opinion, is definitely not really the most bullish area. Yes, I would actually say we are around our support level. But the thing is, personally, I would just be a little bit more careful longing the current price action where we are at the moment. And I'm going to try and explain this, of course, also on today's live stream. Marlon16, welcome to the stream. Ale, welcome to the stream. And also John. Guys, please at 11, how much we can see Bitcoin when candle close. Welcome into the stream. To be honest, you're right now saying where Bitcoin is going to be at 11. Literally, I have no idea, but I'm definitely going to give you some levels to watch on the Bitcoin chart. With it being said, I really do hope everyone today is actually having a great day, and hopefully today's technical analysis is maybe going to give you another perspective to look for on the Bitcoin chart, Ethereum chart, maybe also, of course, on a couple of the altcoins. With it being said, let's go right now actually straight into the Bitcoin price prediction. So what we can actually right now see on the chart. Already yesterday, of course, we were talking about our swing failure pattern from our previous low. We actually got, first of all, some kind of a pull to the upside, rejected at the bottom of the range, another pull to the downside, forming swing failure pattern. We grabbed the liquidity, we stopped out the people from their long positions, and then, of course, we actually got a continuation to the upside here on the BTC price. So, very, very simple. In the video today, I was actually mentioning a price target, where in my opinion was actually a very important resistance level on the Bitcoin chart. So very, very simply, we were looking at this specific resistance level. And actually, if you would apply right now our ascending channel on the chart, you are actually going to see we literally hit our diagonal resistance level on the Bitcoin chart to the dollar accuracy right here. Exactly diagonal level, and then of course we got this pretty significant pull to the downside. Let me just see, of approximately, if we go from the top to the bottom like that, 3.84% on the BTC chart. So if you watch the video, you most probably know why this area is a very important resistance level. And also, for example, if you are in the Discord server, also today I showed you, or actually I said my first take profit area for Bitcoin is going to be our resistance level, 47,000 US dollars. I mean, if you do not believe me, just join our Discord server completely for free. If you're going to go right here from Bitcoin Hyper, what you are going to see. Let me just show you that I have, this one of course was the message I posted today at 12:09 p.m. Of course, this was right now, a couple of hours already ago. Someone actually asked me right here, let me just see. Do you think this is the final pump, then breaks up to 52,000 or drop to 42,000? Of course, I answered, I have no idea if we are going to break 47,000. And that's why that is my take profit area, because it's a resistance level. We can potentially get a rejection from here, but if Bitcoin pumps, next level would be 48,000, where I'll most probably close my long and start looking for a short position. Very, very simple. Once again, it was the key level, it was the resistance level for Bitcoin. As of right now, it does look like we got a rejection from the mid level of our range, which was our take profit area, and right now it does look like we actually got this follow through to the downside. So clearly it was a massive resistance level formed with all of those mid levels. Literally right now, purely looking at those channels, all of the levels, or actually all of the channels, had their middle levels exactly around 47,000 US dollars on the Bitcoin chart. On top of that, it was actually also our golden pocket from swing high to swing low, golden Fibonacci ratio, exactly where we actually got a rejection off of. And also, for example, if you would go, let me just go right now on the 15-minute time frame, because I was not talking about this in the video, but let me go right now on the 15-minute time frame, where you are actually right now going to see going from the low, connecting our higher lows like that, expanding this one to this specific high right here. What you're going to see, it also does look like that on the 15-minute time frame, Bitcoin was forming the ascending channel, very nicely respected diagonal level. I would say this the top level of the channel, and also the bottom of the channel right here, definitely also very nicely respected. We got a rejection almost perfectly from the top of our ascending channel, and then of course a pull to the downside on the Bitcoin price. And let me just remove this channel for now from the chart. Let me just show you where we are at the moment, because Bitcoin right now is actually at the support level. So let me just show you that, because purely right now looking at the price action, right now we are not going to be using any indicators, any other tools, purely looking at the price action right now. What you can right now see on the chart, very, very simple. Going with the rectangle tool right here, what you can see, our previous low, for example, right now we are looking at this low right here, and also we are looking at this specific low right here. So what we can right now say, previous lows for Bitcoin were actually around this specific area. And of course, remember, when we have previous lows, those lows right now looking purely at the market structure, they are going to be our support level for BTC. Once again, not looking at anything else, we can right now identify where Bitcoin is at the moment is definitely, of course, going to be some kind of the resistance level. And of course, also exactly the same thing would be with our resistances. Our previous high was here, going with the rectangle. Once again, of course, we would have a key level around 48,000 US dollars if right now we would actually see a pull to the upside. So So purely right now looking at the price action, previous low exactly here, previous low here, previous low here, current low would actually be exactly, of course, at our support level, horizontal support level, 45,000, let's say 700 US dollars on the Bitcoin chart. But of course, because we are, or at least I do know a little bit more tools, how to actually use them, we can also go around and actually go with other tools to actually identify why this is right now actually a crucial support level here on the BTC chart. First of all, what we are going to use, we are going to look actually at the volume of the entire range. So remember, once again, Bitcoin is right now actually below our specific range, but if we would right now actually measure the entire price action of this specific range, what you are going to see, our value area low volume support level for Bitcoin, once again exactly where we are at the moment, once again around 45,000, let's just say 700 US dollars on the Bitcoin chart. And also what we can right now do, just look at the entire price action Bitcoin has been forming, let's just say from 7th of August 2021. So we are going to expand our fixed range right here a little bit more, and what you're going to see, our biggest volume cluster, looking at this volume profile, clearly you can actually also see, would be around the specific area. Once again, it is the volume area. I mean, this one would be point of control, volume support level, but nevertheless, where we are at the moment, I mean, clearly you can also see, for example, in the past, this red line right here was actually not tested to the dollar accuracy, also not here and also not here. But as of right now, once again, it does look like very, very similar than, for example, here and here. We definitely do have right now our point of control of the entire price action, exactly where Bitcoin is actually right now at the moment. Once again, let's just say 45,600, 700 US dollars here.
Welcome everybody to the B Word. I'm Steve Lee, the lead of Square Crypto, and I'm here today to moderate a discussion about Bitcoin that will span from what makes it special to its relationship with energy, the community ethos, and the future of Bitcoin. I'm joined by three special guests. The first is Cathie Wood, founder, CEO, and CIO of ARK Invest. Next is Elon Musk, techno king of Tesla and chief engineer of SpaceX. And finally, Jack Dorsey, CEO of Square and CEO of Twitter. So we have a lot to talk about today. So let's get to the talk and get right to it. I'm going to start off by asking each of you a question, which is, what's shaped and influenced your views on Bitcoin? And let's start with Cathie.
Okay, Steve, thank you. Well, the first thing was our focus on disruptive innovation. So starting in 2011, Brett Winton, our director of research, who I know will be on the program later, he started talking about this thing called Bitcoin at the time. And it was a curiosity as we were doing our brainstorms in research. But as we learned more about this open source ecosystem, that might fulfill the role of the payment system that the internet neglected to build into the system, not expecting commerce. We thought, this might be something. And then I became even more interested when I realized that my economics would come into play as well here. And Art Laffer, my mentor from USC, and a monetary scholar, in 2014, I asked him if he would collaborate on a paper on Bitcoin, and he was a bit of a naysayer at first, but agreed to read the paper. He read the paper, tore it up, and from an economics point of view, really wanted to understand this. And he said, I think you got something here. This is a rules-based monetary system. I've been waiting for this for my entire career. So the combination of disruptive innovation generally, economics on top of that, and the huge misunderstanding out there as to what this is, that was intriguing and launched our research effort.
Thank you. Elon, what's influenced your views on Bitcoin?
Well, I've thought about money for quite a while, obviously since the PayPal days. and then the companies that preceded that, X.com, which I created, and Confinity, which Peter Thiel, Max Levchin, Luke Howry, and others created. And we combined the companies and made PayPal. So I've been thinking about money for a long time. And really, I think it's best to think of money as an information system, primarily an information system for labor allocation. And for practical purposes, it exists in a series of heterogeneous databases, like very different databases in bank mainframes around the world. It moves quite slowly in reality. It may seem to move fast sometimes, and it does with PayPal, which is real time. But the vast majority of the systems out there are batch processing. So the actual reconciliation may take 1 to 5 business days, sometimes longer. And you have the ACH system, which is ancient and still in operation, which is allows transfers effectively like a check would be an ACH transfer, but it's not secure. And you've got the credit card systems, which are also not secure. It would be like handing your username and password to a stranger in a restaurant if you buy a meal. So there's definitely an opportunity for something that is better from an information theory standpoint. So and there you can think of it like data on a network. I think is the way to view it. What has the most throughput? What has the least error? What drops the fewest packets? Fraud, for example, being a source of error. And government interference in currencies being a source of error. But it's fundamentally an information system. So I think it makes sense to support something that improves the quality of information with which we conduct the economy. And Bitcoin is a candidate for that. It does, I think, some things well, and it's obviously it's evolving, and there are additional things like Lightning being done on top of Bitcoin. But Bitcoin per se is mostly solving for scarcity, or rather solving for essentially having no throat to choke, decentralized. So there's no one who can be coerced in any way to empty their Bitcoin account. Well, I guess they could technically, but on an individual basis, but the system as a whole cannot. And it has an open ledger, which is also quite good. But transaction volume is low. Transaction cost is high, and usability for the average person is not yet very good. But it has a lot of potential. And I should say that, like, I'm not, and I apologize for taking a long time, but there certainly is a lot to say. In general, I'm a supporter of Bitcoin and the idea of cryptocurrency in general. But as I've said publicly, we do need to watch out for crypto taking, especially Bitcoin, using proof of work to maybe use energy that's maybe a bit too much and not necessarily good for the environment. So, but on balance, I support Bitcoin, and I'm not an investor. The only publicly traded stock I own is Tesla, and the only significant thing I own outside of Tesla is my SpaceX stock that could help create both companies. So, but apart from that, I do own Bitcoin, and Tesla owns Bitcoin, SpaceX owns Bitcoin, and then I do personally own a bit of Ethereum and Dogecoin, of course. So.
Okay, great, thank you. And we'll get into some of those issues in more depth as well. Jack, how about you? What shaped your views of Bitcoin?
The network and the community. It's deeply principled. It's weird as hell. It's always evolving, and it just reminded me of the internet when I was a kid. And I encountered alt cypherpunks when I was fairly young, and this was a topic of discussion for years. I didn't touch it until 2008 when we started Square. Elon and teams at X and PayPal inspired a lot of what we were trying to do.